We've been talking about the big market rally coming on the back of a 3-day weekend. Oil is certainly a big part of that. We are seeing WTI today up nearly 3% now. Brent crude up just over 1%. Let's bring in Scott Bauer. He is the CEO of Prosper Trading Academy. And Scott, it's good to have you on today. Let's start with those moves that we are seeing in the market today. Why are we seeing Brent crude so much higher? It's up 2.8% compared to I should say WTI. Why are we seeing that move so much higher?
That's right. It's first day of the week. There's a lot of demand that is starting to come through here based on the opening. Right, based on the reopening of states, and I don't know if it's so much that the data is there that we're seeing cars actually picking up, but it's the prospect of things happening. So what that does is where is the demand going to come from? If we're opening up in the States here, it's going to come from West Texas. And that was a really, really big rally, not just all day here, but into the final minutes of the close today. West Texas rallied almost another % in the last 10, 15 minutes of the day.
It does seem like we're seeing sort of two narratives, right? On the one hand, the reopening is helping lift the oil markets, the sense that demand is in fact coming back up, activity is picking up. And then you've got what's playing out over in China and concerns about whether those tensions could play out and whether that could bring demand down at a time when they're already struggling on the economic front. How do you weigh those risks right now?
Very, very carefully, honestly. And in addition to the risks of U.S.-China tensions, there's estimates out there now with China reopening and demand ramping up in China that they might get up to 13 million barrels per day in the second quarter sometime, which is not quite where it was a year ago, but very close. So you have all of these dynamics. You have this risk of the U.S.-China tensions, but then being offset by potential demand. So I think if you're looking at the entire oil space, you have to keep any sort of trade that an investor or trader is going to make very, very close to the vest here.
So the pickup in the activity that we've seen as a result of the reopening, how should we be looking at that in terms of the big supply glut that we have seen build up over the last 2 months? How far does this go in clearing that?
Right.
And then we'll talk about OPEC on the other end.
Sure. And that's a real tough one because unfortunately, and I don't mean to be a glass half empty, and I'm not a glass half empty person, I'm not quite as optimistic about some of the drawdowns that we might see from the massive supply and storage glut that we've seen coming over the next few months. You look at Baker Hughes, they came out, they just said that rig count was down again by 21 rigs last week, or fell by 21 last week. They now have 237, which is more than 60% less than it was just 2 months ago. So what is going to happen with the massive amount of supply with the storage we have? I don't think it's going to get depleted as quickly as people think it's going to.
So what does that mean for oil prices then?
Well, what it would mean is this rise up that we're seeing, this I don't want to call it a shock, but this quick rise up that we're seeing now, I think really ebbs a little bit, and if anything, is going to put some pressure back to the downside.
We've got another meeting coming up in June with the OPEC members, and obviously they've already agreed to a certain supply cut. Is it just extending that enough to keep prices where they are right now, or do they need to add additional cuts in order to at least try to rebalance the market?
It's a great question, and I still really feel that the impetus behind the oil market is more on the demand side than it is on the supply side. So I think that they are going to keep the status quo as long as OPEC and Russia, so OPEC Plus, are adhering to these initial cuts that we're supposed to get, which they are in May and June. I don't think they're going to raise it. I think that they're going to just kind of play it out a little bit and feel out the demand side of the market. And you know what? If things change, I think they'll be willing to change real quickly with it. But I don't really see them increasing those cuts in the near future.
So the thinking is now, as we go on the next few weeks, the next few months, the reopening process will continue with, in phases. What's the one risk that we should be looking out for? The thinking is if economic activity improves, then demand pushes higher. That's sort of a very overly simplified way of looking at things. But What are you looking at, you think, that could kind of derail the gains that we've seen so far?
So it's not really oversimplified. It's not, because the entire market right now, whether you're looking at the commodity space like oil, other risk on or off asset classes like metals, gold, or the equity market, it's really trading now off of the reopening of the economy and where the growth or the bounce back in the economy is going to be. So the risk is that we reopen and we get data in a week or 3 weeks or 6 weeks, whatever it is, that says, you know what, this didn't go as well as we had hoped for. Now, none of us hope that that is the case. We all hope that these increased phases go very well, very safely. We want that. But I think the overall biggest risk to the entire market, not just commodities, but the equity market as well, is that this reopening sets us back and that we have to pull in the reins a little bit and say, no, we can't do this yet. We have to wait a little bit. Or on another scenario is maybe a second wave, which all the experts and scientists are predicting. Maybe that hits sooner than expected.
Yeah, like so much of what we talk about, a lot of it is going to depend on what happens on the medical front. Scott
Sure.
Bauer, always good to talk to you. Thanks so much.
You too, Kiko. Thank you.